The strategic pivot to decouple from China appears to be yielding consequences that few in power anticipated. The policy, once touted as a straightforward path to revitalise American strength, is now showing significant fractures, and its architects are facing difficult questions about the emerging reality. What we are witnessing is the unravelling of a political narrative. A story that seemed robust in headlines is now buckling under the weight of its own assumptions. And as we investigate further, a more complex picture comes into focus. In this analysis, we will dissect how the foundational claims made by influential figures like Scott Bessent are failing to hold up to scrutiny. We will examine the underlying weaknesses in the US job market that official figures may be obscuring, and we will track how the resulting pressure is now reverberating through the critical technology sector. These are not isolated events. They form a connected sequence, a chain reaction that begins with a potent political claim, translates into trade policy, impacts the livelihoods of workers, and ultimately destabilises financial markets. This is the anatomy of a policy facing a moment of reckoning. We will break down this sequence methodically. You will see why headline employment numbers mask a far more fragile situation. You will understand how the economic decoupling from China has created unforeseen complications, and you will hear the concerns being voiced quietly within financial institutions, signalling deeper systemic concerns. By the end of this report, the full scope will become clear. We will connect the dots between the unravelling narrative, the concealed economic damage, and the market volatility. This will reveal a pattern that explains why many informed observers believe the coming months hold significant and perhaps unappreciated risks. What follows is an investigation into the realities behind the rhetoric. The term cancelling China refers to a concerted political and economic effort within the United States to reduce its dependency on China. This has manifested through tariffs, export controls on technology, investment restrictions, and a broad push to relocate supply chains. Proponents have argued this is a necessary defence against China's ascendancy in manufacturing and technology, a simple equation of reducing foreign reliance to rebuild domestic power. However, beneath this surface lies a set of ideas and assertions that propelled the movement forward. A leading voice in this campaign has been Scott Bessent. He has consistently argued that China's economic growth has directly harmed the American workforce, most notably with the claim that the US lost 3.7 million jobs due to trade with China. This figure has become a cornerstone in debates over tariffs and industrial policy, framing trade not as an opportunity, but as a direct threat. The claim resonated powerfully with a public already concerned by shuttered factories, and despite ongoing debate among economists over its accuracy, it has profoundly shaped the policy landscape. As a result, the political narrative shifted decisively. This new consensus justified tariffs, barriers against Chinese tech firms, and incentives for domestic production. It also drove regulations targeting Chinese involvement in strategic sectors, from semiconductors to electric vehicles. The idea evolved from a phrase into the driving force behind a significant reorientation of trade and technology strategy. The movement gained further momentum as national security concerns merged with economic anxieties. The concept of tech decoupling took hold, prompting companies to shift supply chains not merely for cost, but for political security. Inevitably, China's countermeasures injected further volatility into global markets. The story outgrew its origins. It is no longer about one individual's claims, but a comprehensive framework that now dictates the decisions of politicians, investors, and corporations alike. Understanding this genesis is key to comprehending the powerful and enduring force it represents in today's global economy. The figure of 3.7 million American jobs lost to China, a claim popularised by Scott Bessent, is a dramatic one, and its political potency is undeniable. However, a forensic examination of the data reveals a far more nuanced economic reality. Independent economic studies, including analysis from the Civotus Institute, indicate the actual number of job losses directly attributable to Chinese trade is significantly lower, with some estimates suggesting the true figure is overstated by 2 to 4 times. In practical terms, this points to a real impact closer to 1 million jobs or even fewer, once broader economic shifts are accounted for. This is not to diminish the very real distress experienced in industrial communities, but to clarify that the narrative is more complex than political rhetoric often allows. The decline in US manufacturing employment is a decades-long trend, predating China's economic rise. The primary drivers have been automation, which has systematically replaced repetitive labour, and corporate decisions to move operations to a range of lower-cost nations, from Mexico to Vietnam. This long-term restructuring, driven by technology and global supply chain logistics, is the central story, not Chinese imports alone. Simultaneously, we are observing what can be termed a hidden jobs crash. This is not a sudden, headline-grabbing collapse, but a steady erosion beneath the surface of official statistics. We are seeing a shift from stable full-time positions to contract and gig work. When a skilled manufacturing worker moves into lower-paid, insecure service employment, they are still counted as employed. This statistical reality preserves the appearance of a robust labour market while masking a significant deterioration in the quality and security of work. This recalibration of the jobs data is now fueling a substantive pushback against the broader cancel China narrative. Respected bodies, including the American Enterprise Institute, are publishing research that traces the majority of alleged losses to automation and long-term structural change, rather than trade policy. This challenges the very foundation upon which the most aggressive decoupling strategies were built. Consequently, these doubts are now migrating from academic circles to the financial world. Investors are increasingly nervous. Each new export control on advanced semiconductors or restriction on high-tech equipment, met inevitably by Chinese countermeasures on critical materials, injects profound uncertainty into the markets. When the world's two largest economies enter a period of sustained technological and resource competition, the fear of supply chain disruption and profit erosion translates directly into market volatility, a financial tremor that is felt across the globe. What we are observing is not the dramatic collapse of policy, but a more subtle erosion of its foundational logic. The economic case for rapid decoupling is faltering. As evidence emerges that the projected job losses were significantly overstated, the political justification becomes increasingly difficult to sustain. Furthermore, businesses are now conducting a sober cost-benefit analysis. The reality of relocating complex supply chains, a process that takes years, not months, is proving prohibitively expensive. These costs inevitably are passed on to the consumer. Consequently, many corporations that once publicly supported a sharp break from China are now quietly recalibrating their strategies. Behind closed doors, there is a clear shift towards hybrid models and a slowing of withdrawal plans as the promised economic benefits fail to materialise. Investors are observing this corporate hesitation, and it adds a significant layer of financial pressure to a political narrative that once appeared unassailable. Crucially, this pressure does not remain confined to Whitehall or corporate boardrooms. It transmits directly into the market. The technology sector is the most immediate casualty. Investors, attuned to the slightest political tremor, understand the sector's profound dependency on Chinese manufacturing, rare earth minerals, and consumer markets. Consequently, even rhetorical shifts towards decoupling can trigger sell-offs, as traders price in the risks of supply chain disruption and rising production costs. We saw this sensitivity in action following pointed remarks from commentators like Scott Bessent regarding China's resource control. The immediate market dip was a clear indicator of how influential such statements have become. For tech firms, any hint of instability in the supply of critical components, from semiconductors to battery materials, can prompt a sharp devaluation. These companies are valued on growth and stability. When that stability is questioned, their stocks are often the first to fall. The risks extend beyond supply chains. Many American tech titans rely on the Chinese market for a substantial portion of their revenue. Being shut out could wipe billions from their valuations. This is compounded by a cycle of action and reaction. Each new Western export control on advanced technology is met with Chinese countermeasures on critical raw materials. Every escalation adds another layer of uncertainty into the market, which investors loathe. The result is a volatile environment where a single announcement can spark a sell-off. For smaller firms with thin margins, this volatility poses an existential threat. It creates a self-reinforcing cycle. Fear triggers selling, which lowers valuations, which in turn fuels more fear about the sector's resilience. Ultimately, the impact of these geopolitical tensions is felt far beyond trading floors. It lands squarely in the household budgets of ordinary people. Unstable supply chains increase the cost of goods, from electronics and cars to everyday household items. The rising price of a smartphone or a family car is a direct consequence. Simultaneously, job security erodes. In times of uncertainty, companies freeze hiring and quietly shed staff through attrition or a shift towards part-time and temporary contracts. The most vulnerable are workers in sectors tied to global trade, electronics, engineering, and logistics, who face a future of diminished opportunities, stagnant wages, and increasingly precarious employment. This is the tangible human cost of a geopolitical strategy in transition. A further critical consideration is technological access. An intensified decoupling strategy risks directly impacting consumers through delayed product releases, reduced choice, and a tangible slowdown in the pace of innovation. The reality is that cutting-edge technology, from smartphones to electric vehicles and medical devices, is the product of deeply integrated global supply chains. It relies on a symbiotic relationship between Western design innovation and sophisticated Asian manufacturing. Severing this collaboration doesn't just raise costs, it fractures the very ecosystem that drives progress, slowing the rate at which new advancements reach the public. And let us be clear, these repercussions are not contained by national borders. In an interconnected global economy, a trade and tech conflict between Washington and Beijing sends immediate shockwaves across Europe, Asia, and developing nations. Countries reliant on exporting raw materials to China or importing finished goods from the United States face immediate strain. The result is inflationary pressure as supply chains seize up and factories worldwide are forced to slow production, awaiting components caught in geopolitical crossfires. The job insecurity witnessed in American industrial sectors is mirrored in communities across the globe. For investors, this environment demands constant vigilance. Markets can swing violently on a single announcement of new restrictions or a profit warning linked to supply disruptions. In this climate, understanding the political backdrop is not optional. It is essential for protecting long-term savings and pension funds from unexpected systemic shocks. So, what are the key indicators to monitor? Several signals can reveal the direction of travel. First, scrutinise the US job market data. A low unemployment rate that masks a decline in full-time positions often indicates underlying weakness. Similarly, trends in manufacturing employment are a crucial barometer of corporate confidence. Secondly, watch the implementation of export controls. Each new restriction on semiconductors or advanced software immediately heightens supply chain risks. When major corporations begin reporting delays and shortages, it is a clear sign that tensions are escalating. Thirdly, diplomatic maneuvers are a critical guide. The imposition of new tariffs, or crucially, any signal from Beijing that it may tighten its grip on the export of rare earth minerals, vital for everything from electronics to defense, will create instant turbulence in international markets. This action-reaction cycle is a primary driver of uncertainty. Finally, the performance of the technology sector itself is a leading indicator. When earnings reports from firms with significant exposure to China start containing warnings about supply costs or regulatory pressure, it is a strong signal that conditions are deteriorating. A sudden, sharp sell-off in a tech stock is often the market pricing in political risk, long before it becomes front-page news. In conclusion, the narrative of a swift and cost-free decoupling from China is unravelling. The evidence points not to the advertised renaissance, but to a more complex and challenging reality. A fraying job market, heightened market volatility, and rising costs for consumers and companies alike. This demonstrates a fundamental truth. In a globalised economy, bold political gambits carry significant and often unpredictable economic risks. The effects reverberate far beyond trade balances, impacting inflation, investment, and the financial security of ordinary households. This story is still being written. The coming months will be decisive, revealing whether policymakers choose to persist, pause, or fundamentally recalibrate their strategy.